what can the central bank do? They can just higher the rates. They are supposed to do that in the coming months, right?
Right. They are, but let's talk about the difference between supposed to do it and actually doing it. And I think they will, but here's the problem, Eric. When you raise interest rates, one of the reasons why markets have traded at such high multiples is because we've had low interest rates for so long. And high interest rates cause people to move out of equities and into bonds. And when that happens, equity valuations drop. So earnings may be fine, but you'll get a lower multiple on that. So, there was something called the Greenspan put many years ago. Now it's called the Fed put. And basically at some level, the market will have fallen enough that that basically the Fed will say, okay, well, we don't want to crash the market, right? And it's this conflict between Wall Street and Main Street, where Main Street, the average citizen really needs the Fed to raise rates to get a handle on inflation. But what the Fed, but what Wall Street wants, what the markets want, is low interest rates and high valuations. And so if the market crashes, the Fed put would be, okay, wait, we'll take it easy on interest rates. Now, back in the late 70s, early 80s, Paul Volcker, who was the chairman of the Fed, said, I don't care if I crash the economy, I'm fixing this inflation problem. And he took rates up, I think, past 15%, right? And Chairman Jerome Powell can't do that right now, and he can't do it for two reasons. One is he's afraid he'll crash the market, and if he raised rates that high, he would. And remember, we're coming from negative, in my opinion, 15%, but officially negative 7.5%. But the other issue is the United States has on balance debt of $30 trillion. So what happens when you raise rates? You start to get to interest rates of 4 or 5%, and all of a sudden, all of spending that the U.S. government does is going to be taken up in interest payments. And that's a big problem when you don't have money for a military, for welfare, Medicare, Medicaid, Social Security, right? Any social safety net, any government programs. And, those promises have been made. So, we go back again to your question from before, which was, why does any of this matter? It matters because no matter how this gets solved, people are going to get hurt.
This sounds really serious. So what do you think will happen in the coming year to the stock market, to the interest rate?
Yeah, well, interest rates, they will go up. They have to. The problem is Chairman Powell cannot raise rates as much as he needs to. With $30 trillion of debt and a market that will crash, he just can't. So it's going to be a half-hearted effort. And, it's too bad. It's not entirely his fault, but he doesn't have a lot of good options. Regarding the market, here's what we've chosen to do. We're doing three things. One, we continue to own a limited number of companies that we've researched, written about, and expect will do well, because I think long-term, they're really good stock picks. And then we're hedging the portfolio in two different ways. We have a set of inflation hedges, which we spoke to you about when we checked in with you a couple of months ago. And then I mentioned earlier in this call that in the first week of January, we advised Deep Knowledge Investing subscribers to short the market. And we put out a piece, I think it was out on January 8th, telling people short the S&P 500, short the NASDAQ 100, the ticker's the QQQ. We bought huge amounts of put options on the S&P 500 that doubled and tripled, and then we sold those and bought cheaper options further out and booked huge amounts of profits on that. This is the kind of thing that we're managing very carefully, and I communicate with Deep Knowledge Investing subscribers on that whenever we're doing something like that in the portfolio. So the three pillars we have are own a limited number of great stocks, hedge for inflation, hedge for a market drop, if we have an increase in rates.
So do you think the market will go even lower from here?
I think it's interesting because last week the market was up really big one day because the minutes from the Fed meeting indicated that instead of raising by 50 basis points or 0.5%, they were only going to raise by 25 basis points or 0.25%. And people are excited about that, and okay, fine, but at some point they've got to deal with the problem. So they can kick the can down the road, right? They can let inflation run hot and keep the market high. But at some point they're going to have to raise rates a bit, and I'm not so bullish on what happens in the stock market in a rising rate environment.
Oh, okay. So I also have to mention the situation, the serious situation in Ukraine. How do you see this connected to the rest of the economy? Is it anything that you are looking at?
Well, I think so. First of all, I just want to be clear. The only thing we're really comfortable commenting on is the economic impact. Obviously, there's a potential humanitarian impact if there's war or a country that's invaded. That itself is a horrible thing, but I don't know that our commentary on that is particularly valuable, and it's not why people come to us to take one side or another. But obviously the key issue is that Russia is a huge oil exporter, and they're a huge supplier of European oil. So anything that creates an imbalance of supply in the oil market, and remember, we told people, this is back in, I forget, it was October or November of last year, that when we were hedging for inflation, we were buying oil. Well, great. Well, last I checked, oil was above 90, and certainly anything creating instability in Russia or sanctions that would prevent Russia from exporting oil is going to have a negative impact on the oil market, and by negative impact, I mean higher oil prices. So we've continued to own our oil positions through all of this.
So you have had some really good calls, it sounds like, but what should people do? I mean, what should our investing community do? What should they invest in? Commodities, housing, banks? Do you have any ideas of what people should invest in this inflationary environment?
We do. So our inflation hedges are fortunately not so different than they were a few months ago. We continue to like oil. In that sector, we look at high quality producers that have existing operating wells. And the reason that matters is because environmental concerns make getting new wells permitted. So having an existing supply of oil right now is very valuable. Beyond that, we own gold and silver. If you bring up a chart of gold, that's done really well lately. That's a tough one as well, because storage is difficult for people. You really have three options. One is to store gold at home, but then you have precious metals at home, and you're running theft risk, and depending on whether you live in a high crime area or how much money you want to spend protecting it, that may not be so safe. I don't keep gold in my house for that reason. I just don't think it's the safest way to go. There are people who use dedicated gold storage or safety deposit boxes. I would say in case of emergency, it may be difficult to get your hands on that. A final option is the ETFs GLD for gold and SLV for silver. They do have some expenses, but they're easy ways to do it. Detractors there would say, yeah, but what if they don't own as much gold or silver as they say they do? And there certainly is risk to something like that. So there's no perfect way to play it, but we've continued to own that. Long term, we own Bitcoin as well. Bitcoin has traded as a risk asset, meaning whatever the market has done, Bitcoin has done more. If the market is up, Bitcoin is up more. If the market is down, Bitcoin is down more. So it's traded as a risk asset, but in a hugely dollar inflationary environment, I like the idea of owning a deflationary asset. That's Bitcoin. So those are the key things that we've thought about. Regarding housing, I have two thoughts on housing. One is, in a situation where you have inflation, owning hard assets is a pretty good idea. And owning hard assets that you can leverage is a great idea. So just on a personal note, back a few months ago, I refinanced the mortgage on my house. And it's an inexpensive interest rate. It's a 30-year fixed rate interest only for the first 10 years. So let's think it through for a minute. If we have inflation at somewhere between 7 and 15% for a while, I get to pay the bank back with dollars that won't be worth very much. And, my joke is 30 years from now, here's a pack of gum and a candy bar and use that to pay the mortgage. Now, obviously it won't be that good, but I'm making the point that, you get to pay back that mortgage with dollars that won't be worth as much. The one thing that I would caution people about is higher interest rates mean higher mortgage rates. So if you own a home and you're going to live there and you don't plan on selling it, refinance now, please. Just lock in whatever rate you can get now for as long as you can and do that. The thing that they need to be careful about is, if you're thinking about it as a short-term flip, a short-term trade, that can be a problem in a rising rate environment. So in the United States, I think we're going to see mortgage rates go from around 3% to around 5% over the next year. If that happens, for buyers to have a mortgage payment that's the same, prices need to adjust by 20%. Right? If it's 150 basis points, so 625 basis point increases, mortgage rates go from around 3, or in this case, like 3.5 to 5, you'd be looking at a 16% change in value. And that's a pretty big hit to take. So regarding real estate, the real question is, how long do you plan to hold it?
Okay. Gary, it has been, as always, very interesting. We only have like 30 minutes, so I think we have used all our time already. How can people learn more about you? You have a web page, and people can buy your service, or how does it work?
Yeah, they can. Thanks so much for asking. Anyone watching this who's interested, feel free to go to www.deepknowledgeinvesting.com, and you can sign up directly from the website. We also have a special offer for Invested.dk subscribers. Wow. Eric, we have a special landing page for you. Eric can send that out.
I will send it right away. Yes, when you send it to me, I can. Yeah.
Sure. Great. And we'd be happy to offer all of you a free month, and would love to have you as part of our community as well. Thanks.
What can people expect from your service?
So, like I said before, it's really two key things. One is a limited number of high return, high probability stock picks. The other is we've been very focused on inflation and interest rates, and we've gotten that market call right. We had people positioned in gold back in November. We had people shorting the market the first week of January. We've been really timely on that, and that's been the key call for us. For what it's worth, when we started telling people to hedge for inflation, the expectation for 2022 was the U.S. Federal Reserve would have 0 rate hikes in 2022, right? That it would just be 0. And we said, no, that's not right. Inflation is worse than people think, and start hedging for this. And I saw something over the weekend. Some of the big investment banks are now expecting as many as 9 rate increases. So our work has been predictive, and people have made money because of that.
That's impressive. Well, thank you a lot, Gary. Are you having a holiday down there, or are you just working?
Just working.
Okay.
I just, we can work from anywhere. And so I stay at places that have a really good Wi-Fi connection and co-working spaces. And I'm just living and working in Peru for the month. Last time was Costa Rica. And,
Fantastic.
so I don't know, maybe later in the year, Denmark, who knows?
Yeah, but choose summertime instead of wintertime. Yeah, but you're very welcome.
Thank you.
Thank you. Nice to see you again, and hopefully we can ask you again another time to have an interview with the Invested community.
It would be my great pleasure, Eric. Thank you so much for having me, and to all the members of the Invested.dk community. Thanks for your time. Thanks for joining me at Deep Knowledge Investing, and we really appreciate you. Mange tak.
Thank you. Mange tak. Vi ses. Hej.